Hey everyone, Fiverr reported fourth quarter and fiscal year 2023 earnings results that disappointed Wall Street investors. The stock was down over 14% on the day the announcement was made. So in this video, I'm going to review Fiverr's latest quarterly earnings results. I'm also going to update my recommendation for Fiverr stock. Remember, coming into this quarterly report, I had Fiverr rated as one of my top 24 stocks to buy in 2024. It's one of the few of those top stocks to buy that are underperforming so far in 2024. So I'm going to revisit that recommendation. I'm going to update it and let you know if I'm downgrading Fiverr stock, removing it from the list, or if I'm keeping it up there. So you're not going to want to miss that. So let's jump in. Let's take a look at these results. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. All right, so I mentioned the stock was down on the day following the earnings release, 14.25% to be precise. And now that has Fiverr stock trading at a forward price to earnings of 7.778, a cheap valuation when you think about the company's growth prospects. Starting the year, it was trading a little bit more expensively, a forward price to earnings of around 9. It's now cheaper than where it was to start the year. And we're going to take a look at whether or not that makes sense, whether or not it's still attractive. I certainly found it attractive to begin the year. Otherwise, I wouldn't have placed it on my list of top stocks to buy. So let's take a closer look at these results. All right. So, of course, one of the big risks with Fiverr was how its business was going to be impacted by AI. A lot of bearish arguments against Fiverr stock were noting that people are going to use AI instead of going to Fiverr for some of these tasks to be completed. I argued on the other side that AI was not really going to hurt Fiverr. It might actually help. And according to management, they're saying that AI drove a 4% lift in gross merchandise value, gross market value, how much buyers spent on the platform. Now, their investment in AI and highly skilled categories led to a 4% net positive impact on GMV in 2023. So according to management, AI drove a 4% lift to their results in 2023. Although if I'm being honest, I think Fiverr is overcompensating in this regard. I think they're going to highlight the positives in this area because they understand that investors are fearing this risk. So they're going to go out of their way to mention the good things about how they're using AI to help their business. And given how popular artificial intelligence is, they want to get themselves on the right side of AI. I don't think Fiverr is an AI stock, or I don't think they're going to see a huge lift from AI. I also don't see AI as a big negative because I see it as many jobs as it's going to hurt on the Fiverr platform. I think it's going to create just as many. So I think it's going to be a net neutral for Fiverr's business, the impacts of AI. So moving on, the company increased the take rate by 160 basis points in 2023 to 31.8%. That's one of the highest take rates I've seen on any platform. If you didn't already know, Fiverr operates a marketplace where entrepreneurs and businesses can go to hire people for tasks, hire people for smaller jobs, not full-time jobs or part-time jobs. Just if you need something done, let's say you need somebody to write a script for a YouTube video, or you need somebody to do your thumbnails for your YouTube video. You can go to Fiverr and hire people to do that for you. And Fiverr doesn't employ any of the people completing the tasks. What Fiverr does is just make the platform available, and then it takes a fee from every transaction. That fee is the take rate. 31.8% is really high, and it's moving higher. Now, if you think about other platforms like eBay, Airbnb, Etsy, Uber, DoorDash, Lyft, and others, this is among the highest take rates you'll see on those so-called platforms where people come together and the platform takes a fee for the transaction. 31.8% is the highest, and it's really pushing it. So I'm a little concerned that they're pushing this too far, and we're going to see how that resulted in a change in a certain metric that I want to highlight. So for 2024, they expect the GMV to accelerate. That's great news. They expect to take a balanced approach to drive profitable growth in 2024 with accelerating GMV, a sustainable take rate, so they don't plan to increase the take rate, and continued expansion of adjusted EBITDA. All right. So for the fourth quarter, 91.5 million in revenue was up 10% year over year. Solid growth to be sure. Here was the big negative news from Fiverr's report here. Active buyers of 4.1 million was down 5% year over year. Down 5%. That's not good news, right? You're losing buyers. Buyers are what attract sellers to the platform. If you don't have enough buyers, you're not going to get sellers, and it could cause a negative virtuous cycle. That's where I suggest that this take rate might be pushing it too much, because you're starting to lose a significant amount of buyers on the platform. Because if you're going to charge 32% for these transactions on the platform, then prices are going to increase because there's higher fees. So those that are offering services are going to charge more, so that after the fee, they're still earning a reasonable wage. And so those higher prices could drive away buyers who look at these prices and say, well, that's not really attractive. I don't want to hire somebody at those fees. So they might be pushing it here with the take rate. And management does say, and we're going to see later in the video, they're focused on high value buyers. They're less interested now in these low value buyers, those that don't spend too much on the platform. So that could be another cause of the decrease in buyers and not just the take rate. I don't know. I don't know about that though. I think the take rate is playing a factor here, and we'll see more about that later in the video. So the average spending per buyer, that's good news. It went up by 6%. And the take rate we already talked about. The company delivered a full year of profitability, 4.7 million specifically in GAAP net income in the fourth quarter. And this focus on profitable growth turned out to be extremely successful for Fiverr in 2023. Massive profit increases, massive increases in cash flow from operations. That part was successful, but it seems like it came at the expense of growth. It came at the expense of losing a lot of active buyers. Now, for the full year in 2024, Fiverr is forecasting 6% growth at the midpoint in revenue, 5% for the first quarter, and then adjusted EBITDA for the full year in 2024, a very healthy 65 to 73 million, let's say 68 million at the midpoint here, 69 million at the midpoint of adjusted EBITDA. And if you look at, let's round up to 70 million, and let's say they bring in 380 million in revenue, that's a good percentage of adjusted EBITDA to revenue for Fiverr, coming off a year where they were profitable on the bottom line. So they achieved for the full year 2023 7.1% revenue growth and 16.4% adjusted EBITDA margin, both above the targets they set at the beginning of 2023. And they've been conservative with their guidance. And you probably heard me say multiple times, I don't like when management teams are conservative or optimistic. I just want to get accurate numbers from management. But given that they continue beating on the top and bottom line of their guidance, you can reasonably expect them to beat the guidance that they're setting out for 2024 as well. So overall, GMV on the platform grew by just 1% year over year. But they're noting that this comes at a time where U.S. job openings overall are down 19% year over year, and professional staffing is down 6% year over year. So they're suggesting that the overall macro economy was not doing well, but Fiverr gained market share. So in the next several years, they expect to continue make steady, measurable annual progress in driving bottom line expansion while investing in top line growth. So they're looking at profitable growth. They expect the GMV to accelerate by 1 to 2% compared to 2023, with accelerating growth in spend per buyer. And here's some more bad news. They expect similar active buyer trends as in 2023. So for 2024, they expect to continue losing active buyers. So not only did they lose active buyers in 2023, they expect that trend to continue in 2024. And that's really what I think drove down Fiverr's stock price following this announcement, following this guidance. Investors are not happy with the company continuing to lose active buyers, because that's eventually going to lead to lower revenue and lower profitability. Remember, we saw a similar trend with PayPal. If you've been following my PayPal videos, PayPal had been losing millions of active accounts, and for a while their earnings per share were still doing well, still growing, still profitable, still increasing by double digits. And then now for 2024, PayPal said, okay, now we're starting to feel the impact of all those losses. And 2024, they're guiding for flat earnings per share, no growth in earnings per share. There is a fear that Fiverr will follow that similar trend, where for now they're losing these active buyers, but it's being made up by the higher take rate and the higher spending per buyer. But eventually that's going to result in lower profit growth from Fiverr. All right, a few things I did like with Fiverr is, even though they increased their revenue, they did so by decreasing sales and marketing spending, both for the most recent quarter and the year. Look at sales and marketing was down by 13 million on the year, from 174 million to 161, and down by about 700,000 in the most recent quarter. What I was not happy with was the increase in spending in general and administrative. These are corporate expenses that I prefer to see either flat or coming down. But you could see net income of 4.7 million was a big improvement from a loss of 1.3 million in the same quarter the prior year. And then for the full year, 3.7 million in net income was a big improvement from a $71 million loss during 2022. So big improvements in profitability from Fiverr, even though it's coming at the expense of active buyer growth. And then the last thing I'll share is the similar increase in cash flow from operations, which nearly tripled in the latest quarter to 27.5 million, up from 9.6 million. And then for the full year, 83 million in cash flow from operations, which was up from just 30 million in the same metric the year before. So solid growth in profitability and cash flow, although it's coming at the expense of active buyers. And I'm not sure that's a prudent strategy from Fiverr here, given that they've made so much progress on cash flow and profitability. I think they can afford to sacrifice some of that growth in profits to retain these buyers, to retain some active buyers, or find a way, a promotional activity or some kind of customer acquisition to increase their buyer or stop all these buyer losses, stop losing all of these buyers. All that being said, I still like Fiverr stock. I still like the value in the stock. It's trading at a forward price to earnings of less than 10. It's trading at a valuation like AT&T and Verizon, which are no growth stocks, which are operating in a mature industry. Fiverr still has growth ahead, but right now it's focusing a lot on profitability and improving the metrics. So the risk certainly increased with this company, with this guidance. So I'll be paying closer attention to Fiverr, but the valuation also improved. So there was a give and take here. All things being considered, I'm still keeping Fiverr stock rated as one of my top stocks to buy in 2024. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.